to record any classes kind of going forward. So, you know, it only occurred to me last week. So if anybody wants me to record something in particular, just let me know. Okay, so the question that we have is Joey. So we're told that Joey commenced employment with Jump for Joy Limited in period 3 of the 2025 tax year. He didn't provide his PPS number, calculate his PAYE, PRSI, USC and net pay for each week based on the following earnings. And we're told that in period 3 he earned 485, period 4 540, period 5 685, and period 6 870. So we know that when somebody doesn't provide their PPS number, they're going to be on the emergency basis of tax. And we know that where they do provide their PPS number, they are entitled for the first 4 weeks to one basis of emergency tax. So these are the rules for emergency basis of tax. So where they have provided, where the employee does not provide their PPS number, they get the benefit of no tax credit or no cutoff point. Where they do provide their PPS number for weeks 1 to 4, they get a cutoff point of 846 and no tax credit. And from week 5 onwards, no tax credit and no cutoff point. Okay, so we know that Joey came in with one hand longer than the other, no PPS number. So everything is going to be taxed at the 40%. Okay. So, oops. Okay, so for the first week 3, 4, 5, and 6, he's on the emergency basis of tax. Sorry, I'm just going to delete those. So weeks 3, 4, 5, 6, he's on the emergency base. He's on the emergency basis of tax. You're grand, you're grand, you're grand. I thought it was me hitting something, so sorry. So in week 3, 4, 5, I've just popped in the details from the question. I'm going to hide these so that they're not cluttering up our screen. Oh God, just hide everything so it's not cluttering the screen. Okay, so week 3, 4, 5, and 6, I've just popped in the details from the question. So he's on emergency tax. So in week 3, he has no standard rate cutoff point. So remember I was saying to you that when we're looking at the tax deduction card, we treat the, you know, the question to ask ourselves is kind of like the generation game. Are his wages higher or lower than his standard rate cutoff point? So in this case, he has gross pay of 485 with a standard rate cutoff point of 0. So therefore, all of his wages are higher than his standard rate cutoff point. So he won't pay anything at the low rate of tax. He'll pay it all at the high rate. So he's going to pay it all at 40%. So that's 485 multiplied by 40%. So that gives him total gross tax, which will be the tax due at rate 1 plus the tax due at rate 2, gives us his gross tax. That works out at 194. We know he's on emergency tax, and because of that, he has no tax credit. So we know the purpose of the tax credit is to reduce down the amount of tax that somebody pays. He has no tax credit. So therefore, this week, his tax due will be his gross tax of 194 less his tax credits of 0. So this week, his tax due will be 194. His tax deducted is obviously therefore going to be the full 194. Okay, so for payroll people, having them on emergency rate of tax is really, really easy. You know, where we just did everything there at 40%, we gave no tax credits, we just multiplied the whole amount out. It was grand and handy. Okay, so it's going to be the same for week 4, 5, and 6. It's going to be calculated at the full 40% because he has no standard rate cutoff point and no tax credits. Okay, so I'm just going to pop those in. So, yep. Yep. For cumulative tax after the tax credit. Yep. We left that blank. Yep. Put in the amounts then for the tax deducted. Yeah, it's the same difference, doesn't matter. You can put in the same, can you? Yep. Okay, so it's just literally multiplying. He has no standard rate cutoff point, so his full wages are going to be all at 40%. Total gross tax is tax rate 1 plus tax rate 2, so 0 plus 348. No tax credit, so this week he will pay a tax of 348. Okay, so does the emergency basis make sense? We happy with that? Perfect. Okay. Now, just going to hide these lads again, get them out of my sight. Okay, so then we're told that what are we told? We're told that in period 7, his previous pay and tax details became available when he provided his PPS number. This showed previous earnings in 2025 of €1,200 and tax paid of €85 and USC paid of 34. The Revenue Online system showed a standard rate cutoff point of 34,550 and tax credits of €3,300 and indicated that a week 1 basis of taxation should apply. Okay, so I've popped in the 720 and the 980 just for ease of, I'm just going to hide those so that I can see it. So I've popped in the 720 and the 980 to show that that's what he earned those 2 weeks. We're told that he had previous earnings of €1,200. Okay, so I just pop that in so that I don't forget it. But when he's on week 1, the important thing to remember when somebody's on week 1, yes, they will get the benefit of a standard rate cutoff point and tax credit, but they won't get a tax refund. Okay, so all we're doing is we're looking at that week in isolation. What happened beforehand is irrelevant when somebody's on week 1. They will never get a tax refund. So we can see that, we will see in a few minutes that, he has paid tax at the high rate here every single week. But we're going to see in a second, he'll get the benefit of a standard rate cutoff point. And if he'd had that in the previous weeks, he wouldn't have paid all of his tax at the high rate. Okay. So chances are he's going to be due a refund, but he won't get it while he's on week 1. Okay. He'll only get it when he eventually moves on to cumulative. So his wages here, I'm just going to again pop the €1,200 in just for completeness, just so that I have it. We're told that he has a standard rate cutoff point of 34,550. Okay. And when he's on a week 1 basis, we literally just need to see how much is that per week. So it's 664.42. So that was just the full annual amount of 34,550 divided by 52 gives us 664.42. Now, somebody can stay on a week 1 basis for the whole entire year, or they may go on to week 1 in week 47 and they'll stay on it. They may go on to week 1 in period 26 and they stay on it. Revenue are the people who determine whether somebody goes on a week 1 basis. We can't override it and we shouldn't override it. Okay, so if revenue says somebody's on a week 1, we leave them on it because we don't know why they've been put on a week 1 basis. So it's not for us to second guess revenue. We literally take the instruction we've been given. So in this case, he has a standard rate cutoff point for the year of 34,550. We've just worked out what that's going to be for every week. So 34,550 divided by 52 gives us his weekly amount. Going to do the same with his tax credit. We're told he has an annual tax credit of 3,300. So we're just going to work that out. 3,300 divided by 52 works out at 63.46 per week. Okay. Happy with those figures? Perfect. So we come along then and we're saying, okay, how much tax is he going to pay at the high rate and at the low rate? So if we take the tax due at rate 1 first, we can see that he has a standard rate cutoff point of 664.42. His gross pay this week is 720. So is he higher or lower than his standard rate cutoff point? He's higher. So what that tells us is that the first 664.42 will be taxed at the standard rate, and the balance, the difference between those two, will be taxed at the high rate. So we'll do that. 664.42 at 20% works out at 132.88. Then the balance, the difference between the 720 of his wages less the standard rate cutoff point, will be taxed at 40%. Okay, and that's the same as we did when we did our annual calculation. It's just this time we're just looking at it on a weekly basis. Okay, so that's 720 minus the 664.42 was taxed at the high rate of 40%. Then we're just going to add the two of those up. So the 132 plus the 22.23 gives us 155 is his gross tax due. Okay, so adding the two of those, 155.12. Happy with those figures where they're coming from? No? Which one? The 132? Okay, that's fine. So we've looked. Are you happy with where the 664.42 is coming from, the standard rate cutoff point? I do. Yep, perfect. So then we just ask ourselves, are his wages higher or lower than his standard rate cutoff point? So in this case, in this particular week, his wages of 720 are higher than his standard rate cutoff point of 664.42. Okay. So what we do is we take the first 664.42 and we multiply that by the standard rate of 20%. Okay. So 664 by 20% gives us 132. Happy with that? Okay. So then we have to say, okay, he has earnings of 720. We've already dealt with the 664. So now we're just going to say how much of his wages are liable to be taxed at the high rate. And that's the 720 minus the 664 will be taxed at 40%. And that gives us 22.23. Okay, so that 132 is the 664.42 by 20%. This lad is the 720 less the standard rate cutoff point at 40%. We add the two of those together and it gives us 155.12. So then we say, okay, 155.12 is his gross tax. Let's take away his tax credit. So this week he will pay tax of 91.65. Okay with that? Okay. So then period 10, again, he has a standard rate cutoff point of 664.42. He has wages of 980. So his wages this week are higher than his standard rate cutoff point. So what that means is the first 664.42 of his wages will be taxed at 20%, and the balance, the difference between those two figures, will be taxed at 40%. So we say 664.42 will be at 20%, and the balance, the difference between the wages of 980 less the standard rate cutoff point, will be taxed at 40%. So this week he's going to pay a fair bit of tax, and I suppose he's earning good wages, so that makes sense. So we add the two of those together and it comes to 259.12, and that's his gross tax. So we're going to reduce that down by the tax credit of 63.46. So this week he will pay 259 less his tax credits. This week he'll pay 195.66. Okay, and it makes sense. Like you're kind of looking and going, there's a big jump in tax between week 9 and week 10, but there's also a big jump in earnings between week 9 and week 10. So it makes sense that his tax would also go up. Okay. Okay, so we've had 4 weeks of emergency. We've had 2 weeks of week 1. Okay. So you can see there's a bit of a difference in the amount of tax that he's paying. Like when he was earning 485, he was paying tax of 194. on wages of 720, he's paying tax of 91.65. So that's the advantage of the week one basis, that it will give him at least a standard rate cutoff point and a tax credit. Does that make sense? I should just record myself saying, does that make sense? And then I get ignored where you all just say nothing or say yes. So, okay. So are we happy with the week one and the emergency? Okay. Okay, so let's then, in week, what are we told? In period 9, we're told that we received a cumulative cert from revenue, which showed a standard rate cutoff point of 36,580 and tax credits of 4,825. So I'm just going to pop those there so that I can remember them. 36,580 and tax credits of 4,825. Now he has moved on to cumulative. So what cumulative means is that we keep recalculating. So we have to take account of what he has earned so far this year. And we keep doing that. So if we're in period 9, we take account of what he earned in the previous periods. When we're in week 12, we're taking account of what he earned in the previous 11 periods. And you keep doing that all the way through the year. So you're constantly recalculating. So you're constantly recalculating wages and tax. But because we're rolling forward his pay, we also have to take, give him the benefit of that extra tax credits and cutoff point. So if we're in period 20, he's entitled to 20 weeks of tax credits and 20 weeks of cutoff point, because it would be unfair for us to just look at 20 weeks of pay and just give him 1 week of tax credit and 1 week of cutoff point. So if you're rolling forward the wages, you also have to roll forward the tax credits and cutoff point. Okay, so to do that, I'm just going to work out what is one of those. Okay, so just 36,580 divided by 52 works out at 703.46. Okay, but we're going to give him 9 of those because we're in period 9. We'll then give him 10 of them, we'll give him 11 of them, we'll give him 12 of them. So each week he's going to get an additional standard rate cutoff point. So I'm just going to cheat and get Excel to do it for me. Oh, sure. Isn't why have a dog and bark yourself like? So hopefully that's right. Yeah. Okay. So it's given them the benefit of 9 weeks standard rate cutoff point, 10 weeks standard rate cutoff point, 11 or whatever. So that was literally just the 36,580 divided by 52 gave me 703.46 per week. And I just multiplied it then by 9, by 10, by 11, and by 12. Does that make sense? Sure? Okay. So same with the tax credits, just to fill that in. So the 4,825 divided by 52 is 92.79. So he's going to get 92.79 of them. So he's going to get 92.79 multiplied by the week number. So week 9, week 10, week 11, and week 12. Okay. So 4,825 divided by 52 gives us his weekly tax credits. And then we just multiply them by the week number to get the cumulative tax credits and cutoff point. Okay. We also need to take account of his gross pay and tax paid to date. So we know when he was with us, he earned this. We were told by revenue that he had previous earnings this tax year with another employer. And then he went on and earned more money with us. So I'm just going to add up everything that he earned so far this year with us and with the previous employer. And it comes to 5,480 euros. Okay, so that's Excel adding it up for me. So hopefully that's right. So I'm just going to delete those. Okay, so 5,480 is what he has earned so far this year. Okay. Same with his tax. I'm just going to see, well, how much tax did he pay with us? So when he was on, it was 85. So He paid a lot of tax when he was on emergency. Revenue told us about the 85 euros that he paid with the previous employer, and then he had 2 weeks of week 1 with us. So he has paid tax of 1404.31. Okay. Okay. Happy with where those figures are coming from? Yeah, no, you're grand because sorry, I started to doubt myself. So that was what he earned or paid while he was on emergency tax. Revenue told us about 85 euros that he had paid with a previous employer, and then the 91.65 and the 195.66 comes to 1404.31. So it's just adding up the tax that he paid each week. Okay, happy with that? Okay. So then in week 9, he's now moved on to the cumulative basis of tax. He had previously, to the end of week 8, he had earned 5,480 euros. In week 9, he earns an additional 580 euros. So his cumulative salary is the 5,480 plus what he earned this week of 580. So at the end of week 9, he has earned 6,060 euros. Okay. So we're then just asking ourselves, it's the same process as we did with the week 1. What has he earned? Are his wages higher or lower than his standard rate cutoff point? So in week 9, he has earned a total of 6,060 euros. He has a standard rate cutoff point of 6,331.15. So his wages are lower than his standard rate cutoff point. So what that means is that he will pay all of his tax at 20%. So we're just saying 6,060 by 20%. He has nothing at the high rate of tax because all of his wages are lower than his standard rate cutoff point. So nothing there. So his total gross tax this week is 1212. He has a cumulative tax credit of 83510. So what that's going to do is reduce down the amount of tax that he should pay. So 1212 minus the 835 tells us that at the end of this week, he should have paid tax of 376.90. Okay. On those earnings of 6060. We know he has paid tax of 1404.31. So this week he's a very happy little chap. He's going to get a tax refund of the difference. So this week he will get 1404 less the 376.90. So this week he's getting a refund of 1027.41. Okay. Happy with that? Okay. We'll see week 10. This where the real magic happens in week 10 now, kind of when the full effective cumulative kicks in. So at the end of week 10, he earns an additional 520 euros, which brings his total earnings to 6580. So again, playing our little generation game, his wages are lower than his standard rate cutoff point. So he will pay tax at a rate of 20%, nothing at the high rate. So it'll be the 6580 by 20%. Nothing at the high rate. So add the two of those together and we get 1316. He has his cumulative tax credit of 927.88. So this week he should pay tax, or sorry, he should have paid tax of 388 euros 12 cent based on earnings of 6580. We know that he has paid how much tax? Yeah, he has paid 376.90. So this week he will only pay the difference between those two. and this week he will pay tax of €11.21. Okay, so this is the real benefit of cumulative. This is where it really kicks in and we see the advantage of it. Okay. In week 11 then, he earns an additional €625. So this week he has total earnings of 7,205. Sorry, I'm just going to make that a little bit bigger. So this week he has total earnings of 7,205. We know that he has a standard rate cutoff point of 7,73808. So his wages are lower than his standard rate cutoff point. So again, his rate of tax will be 20%. So it's just his wages multiplied by 20%. He doesn't pay any of his tax at the high rate. So his total gross tax this week is 1,441. He has a cumulative tax credit of 102,067. So this week, by the end of this week, he should have paid tax of 420.33. He has paid tax of 388. So therefore, this week he will pay the difference of 32.21. And our last week, then he has earnings of 7,205 to the end of the previous week. He earns an additional 820. So this week he has total gross earnings of 8,025. Again, it's below his standard rate cutoff point, so it will all be taxed at the standard rate of 20%. Nothing due at the high rate, so total gross tax of 1,605. He has a tax credit of 1,11346. So we minus one from the other and we get tax due of 491.54. That's how much tax he should have paid. He has paid 420.33. So this week he will pay the difference, 491 minus the 420. This week he will pay tax of 71.21. Okay. Now, so I'm just going to stop recording for